Hi everyone. In today's video, let's see how to build a cash flow forecast for your business. What is a cash flow forecast? A cash flow forecast is a way of looking ahead to see how much cash you will receive in the future and how much you will spend. It tells if there will be enough cash to pay for your expenses like rent, salaries, supplier payments, and other expenses so that your business can keep operating. Without cash forecasting, a sudden expense may cause panic or even halt business operations. With forecast, we can negotiate better terms with vendors or suppliers, secure financing, or adjust spending. The cash flow forecast is important not just for the survival of your business, but also for its growth. Timely payments to suppliers, employees, and creditors maintain trust and build reputation. With cash flow forecasting, you can better plan for expansion of business that may involve purchasing equipments and hiring new employees. It would show whether expansion plans are financially viable and prevents overextension. Imagine a retail business heading into the holiday season. A forecast shows strong inflows in December, but a sharp drop in January. With this insight, management can: number one, save surplus cash from December to cover January expenses, delay non essential purchases until cash stabilizes, and number three, secure short term financing ahead of time rather than scrambling when funds run low. Now, let's start building a simple cash flow forecast template in Excel. Start with the opening cash or cash balance at the beginning of the month. Next, add the months in the row above the opening cash. I suggest to always have a 12 months forecast. So I have started with January 2025 and ran it up to December. Next, list all the ways in which you receive cash. These will be your cash inflows. The obvious ones are cash sales, and if you have credit sales, the collection from customers. There might be other sources of cash inflow like interest income, cash from new loans, or additional capital injections. Next, list all the cash outflows, means the payments you need to make. You can start with your fixed costs like rent, utilities, and subscriptions, followed by the salaries you pay for your employees, payments to your suppliers for your purchases, any taxes, interest payments, capital expenditures, and etc. Next, you can fill up all the forecast figures for your cash inflows for all the 12 months and also the forecast figure for your cash outflows for the 12 months. Add a formula here to sum up the cash inflows. You just have to simply add the sum formula and drag it for the 12 months. Repeat the same steps for the cash outflows. Sum the cash outflows. Then compute the net cash movement. The formula would be equals total cash inflows minus total cash outflows. And do the same thing, track the formula for the 12 months. Next, compute the ending balance. The formula would be equals opening balance plus the net cash movements. And drag this formula also for the 12 months. Finally, fill up the opening balance. You just have to fill in the opening balance for the first month of the forecast. In this case, I'm going to fill up the opening balance for January. The ending balance of the current month would be the opening balance of the following month, which means the ending balance of January, ending cash balance of January, would be the opening cash balance for February. We can automate this by linking the opening balance to the prior month's ending balance. So just enter equals and select the ending cash balance of the previous month. You can also drag this up to December. This is how you prepare a simple cash flow forecast. In part 2 of this video, we will see how to study this forecast and make it useful.